Thank you, Mr. President. I ask unanimous consent to dispense with the quorum call.
Without objection.
And, Mr. President, I ask unanimous consent to speak as if in morning business.
The Senate is in morning business.
Okay. Thank you, Mr. President. I ask unanimous consent that I will be joined in a colloquy with Senator Merkley of Oregon and Senator Coons of Delaware. Without objection. Thank you, Mr. President. During the financial crisis, $13 trillion, $13,000 billion in household wealth was erased. 9 million jobs lost, 5 million Americans, 5 million families, individuals lost their homes. The financial services industry has bounced back. Far too many American families have not. While many in Washington may have forgotten the financial crisis, millions of Americans haven't forgotten how predatory lending practices contributed to the housing bubble, helped spark this crisis. For them, this was the crisis. Unscrupulous lenders offered loans that required no documentation, loans with teaser interest rates that later spiked, undermined a borrower's ability to repay, and loans where borrowers never paid down their principal. Borrowers with these higher cost loans were foreclosed upon at almost triple the rate of borrowers with conforming 30-year fixed rate mortgages. The crisis revealed a host of other harmful practices: steering borrowers to affiliated companies, kickbacks for business referrals, inflated appraisals, loan officer compensation based on the loan product which they peddled. These practices offered little benefit to the borrower. They were not about helping those families. They were not about helping those families purchase a home they could afford. It's no coincidence that as borrowers' costs increased, so did loan officers' compensation. These abuses didn't just start in 2007 and 2008. In many communities, predatory lenders began moving in a decade or more before the crisis. In Ohio, the housing crisis was a slow burn rather than the boom and bust cycle that happened in states like California and Arizona. From 1995 to 2009, think about this. My state of Ohio had 14 consecutive years where there were more foreclosures than the year before. 14 years in a row, the number of foreclosures went up and up and up and up, 14 years in a row. My wife and I live in Slavic Village, just south of Slavic Village in Cleveland, zip code 44105. I mentioned that zip code because in 2007, that zip code had the highest foreclosure rates of any zip code in the United States of America. This wasn't because of speculation. This was a declining industrial base, and this was the kind of predatory lending that tended to settle and sink its talons into communities like Slavic Village. Government policies favoring finance over manufacturing caused steel mills across Northeast Ohio and the rest of the country to shut down and force people to look elsewhere for work. Between 2000 and 2010, the population in Slavic Village dropped 27%, down to 20,000 people, and then the subprime lending industry moved in. By 2006, more than 900 of the Slavic Village's 3,000 properties, 900 out of 3,000 were in foreclosure. And if the home next door to you is foreclosed on and abandoned, you can bet that the value of your home begins to decline, 2%, 3%, 4%, then one down the street, then one across the street, and you can see what happens to this neighborhood. 1 in 3 Ohioans at the height of the crisis in 2009, 1 of 3 Ohioans with mortgages was underwater, meaning their homes were worth less than the amount they owed. 1 in every 7 mortgage holders was 30 days delinquent or in foreclosures. Behind every foreclosure was a painful conversation. We don't think much about that here. We think of numbers and policies and statistics. But imagine you're a mother or a father, you have a 12 and a 13-year-old son and daughter. First, the mother loses her job. Things change around the house. You begin to cut back on things. Maybe you take a little money out of the college fund to send your child to Cuyahoga Community College. Then the husband loses his job. Then you have to have that discussion. 5 million of these discussions at least went on in these 5 million homes where there are foreclosures, where you have to explain to your son and daughter, well, we're not going to be living here. We're going to have to move. We can't afford this house. We're going to leave your neighborhood. We're probably going to a different school. We don't know where we're moving. We're going to have to find a new place to live. Maybe we're going to have to give away our family pet. There's a shelter in Parma, Ohio that went from 200 to 2,000 dogs that dogs and cats that they were housing, because so many people gave up their pets because of the foreclosures that so many families endured. We came together as a result to pass Wall Street reform so that families would no longer be forced to upend their lives because a mortgage company preyed upon them. Dodd-Frank established a common sense rule that requires lenders to ensure that borrowers have the ability to repay their home loans. We created the Consumer Financial Protection Bureau to make sure that never again would consumers be an afterthought. Much of the CFPB's important work is centered on mortgage regulation. The rule to streamline forms will help consumers understand what's happening at the closing table. The ability to pay a qualified mortgage rule balances the need for mortgage credit with the need for documentation of income and other borrower protections. We know there's more to be done. We must ensure that small lenders and community institutions can remain competitive. We know how bank concentration has become more and more of a problem. We must provide homeowners with protections from a broken servicing model that has harmed so many of our communities. We must ensure broad access to affordable housing, the right thing to do for families and for communities. We must move forward. We know there will be a clear choice. We can accept. As we move forward, we know that there are two paths to follow. We can accept the false narrative that inaccurately blames low-income borrowers and their federal programs, FHA, VA, that maintain their underwriting standards during the boom. In other words, we can blame the victim. We can say, oh, it was the homeowners that caused this. It was the people that got the mortgage. It's all their fault that they weren't smart enough and they were so irresponsible. And we can blame the government because it's always the government's fault. Or we can recognize there were flawed incentives encouraged by a lack of regulatory oversight at the heart of our nation's financial system. Flawed incentives that made risk-taking more profitable, flawed incentives that made loan officers compensate increasingly when they made loans that they shouldn't have been making. We can maintain the 30-year fixed-rate mortgage that's made homeownership more affordable and given so many families an asset upon retirement. We can preserve a strong government role in the mortgage market, but instead, too many in this body want to undermine the reforms that we put in place 5 years ago. Republicans and their allies in the financial industry fought on behalf of Wall Street. They fought Wall Street reform every step of the way. They've been attacking these consumer protections since the day they began. We have to remember what a top financial services lobbyist said 5 years ago yesterday. The day the President of the United States signed Dodd-Frank, the top lobbyist for the financial service industry said, well, folks, today is halftime. Today is halftime, meaning, okay, we lost in Congress, but we're going to keep pushing these agencies. We're going to keep lobbying Congress. We're going to keep trying to roll back these rules. We're going to stop these rules. We're going to dilute these rules and make them ineffective. The bill my Republican colleagues today on the Appropriations Committee, Senator Coons will talk about that. The bill that the Republicans brought into Senator Merkley's in my banking committee isn't a narrower targeted effort at reform for small banks. It's a sweeping overhaul that rolls back Wall Street reform. Once again, they want to undermine consumer protection. They want to use small Main Street institutions as cover. But in the end, they want to allow special interests and their allies to undermine reform and leave the American people exposed to the problems that happened less than a decade ago. It's unconscionable that this abuse was ever allowed in the first place. Senator Merkley, a leader on this issue, especially in the Volcker rule, will speak about his efforts, what he's seen in the past, and particularly looking forward to the future about what we do about predatory loans and people preying on banks, preying on consumers.